Welcome to StockTok's deep dive into Westpac Banking Corp. Westpac is Australia's second largest bank by market capitalization, a systemically important financial institution with operations spanning retail banking, business banking, wealth management, and institutional markets across the Asia-Pacific region. The bank serves millions of customers and is a central pillar of the Australian financial system. Westpac trades within a 52-week range from $18.70 to $30.71, placing the current price near the middle of that range. As of May 11, the stock is trading at $26.98. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Westpac generates revenue primarily through net interest income, the spread between the rates it pays on deposits and the rates it charges on loans, along with fee income from transaction services, lending, insurance, and wealth management products. Its competitive moat rests on several factors. First, switching costs. Australian households and businesses are deeply embedded in their banking relationships due to the friction of moving mortgages and transactional accounts. Second, the duopoly structure of Australian banking. Westpac, Commonwealth Bank, ANTS, and NAB collectively dominate the market with limited new entrants, creates pricing power and scale advantages. Third, brand recognition and the expectation that Westpac, as a systemic institution, carries implicit government backing. The StockTok score for Westpac is 23 out of 100, rated avoid. Breaking that down, valuation is 4 out of 20, financial health is 6 out of 20, profitability is 10 out of 20, growth is 3 out of 20, and smart money interest is 0 out of 20. Now valuation. The question every investor has to answer: are you paying the right price? Westpac is trading at 19.28 times trailing 12-month earnings, with a forward price-to-earnings multiple of 17.96. At face value, that looks reasonable for a large-cap bank. However, the price-to-earnings-to-growth ratio, or PEG, sits at 7.98. For context, a PEG below 1 typically signals an undervalued opportunity on a growth-adjusted basis. Above 2 is considered expensive. A PEG of 7.98 is materially elevated and suggests that the market is not pricing in much earnings growth relative to the current valuation multiple. The price-to-sales ratio of 6.34 is similarly stretched for a financial services company. The enterprise value to EBITDA metric is not meaningful in this analysis due to how banking earnings are structured, but taken together, these valuation signals paint a picture of a stock that is not inexpensive relative to its earnings power. Turning to fair value, our DCF model indicates that the stock is trading at a 0% margin of safety to intrinsic value, meaning the market price is aligned with the model's estimate of fair value. There is no buffer for error. Wall Street analyst consensus is not provided in this data set, but the lack of a meaningful discount to intrinsic value combined with the elevated PEG ratio suggests limited margin of safety. Market sentiment around Westpac leans bearish. The bank is holding near record highs despite a $75 million financial hit, while expert analysts are issuing sell alerts on the stock amid concerns about interest rate pressures on Australian homeowners and the banking sector's profitability outlook. Taking all signals together, a reasonable fair value range in our view sits between the current level of approximately $27 and $29, offering minimal upside and significant downside risk if financial conditions deteriorate. The setup does not look compelling to us at present valuations. Moving to financial strength, how solid is the foundation? We look to two critical diagnostic tools. The Piotroski F-score is a 9-point checklist that assigns 1 point for each healthy signal across profitability, operating efficiency, and leverage metrics. Westpac scores 5 out of 9, which lands in the lower middle range. That signals mixed financial health, some areas of strength, but material constraints elsewhere. The Altman Z score is a bankruptcy risk model that combines profitability, leverage, liquidity, solvency, and activity ratios into a single score. A Z-score above 2.99 is considered safe, Between 1.1 and 2.99 is the gray zone, and below 1.1 indicates distress. Westpac Z-score is reported as 0, which falls into severe distress territory. This is an extreme signal that warrants immediate scrutiny. On the balance sheet itself, the cash-to-debt ratio is 0.24, meaning Westpac has only 24 cents of cash for every dollar of debt. For context, financial institutions typically run leaner on cash than manufacturers, but this ratio remains tight. The current ratio, which measures short-term liquidity, is reported as 0.00, which is not a meaningful metric for banks. It reflects the way bank balance sheets are structured and is not an indicator of distress in the traditional sense. However, the debt-to-equity ratio of 2.91 is elevated. A bank is essentially a leveraged equity vehicle, so a 2.91 debt-to-equity is not out of line for the industry. But combined with the alarming Altman Z score and the tight cash position, the overall financial picture is one of constraint and risk. Interest coverage, the ability to service debt from operating earnings, is not calculable from the provided data. The verdict on financial strength is cautious. The balance sheet is leverage-heavy, and the distress score raises significant questions about the company's resilience under stress. Next up, profitability. Is this business actually making money efficiently? The foundation of profitability analysis is return on invested capital, or return on invested capital. This metric tells us how many dollars of profit the company generates for every dollar of capital deployed. Westpac's return on invested capital is reported as 0.00, which is not meaningful and suggests either a calculation artifact or that the metric is not applicable to the banking model in this data set. More useful are the margin metrics. Gross margin and operating margin are reported as 0%. Again, reflecting the nature of banking earnings models, where traditional gross margins do not apply. The net profit margin of 30.89% is the key profitability metric. This means that for every $100 of revenue, Westpac keeps approximately $31 as net profit after all expenses. For a bank, that is a healthy bottom-line conversion, indicating strong cost control or pricing power or both. The free cash flow margin of 35.74% is even stronger, suggesting the company converts more than one-third of revenue into cash available to shareholders. Return on equity of 9.58% is the critical metric for a financial institution. ROE tells us how much profit management generates for every dollar of shareholder capital. A 9.58% ROE is material, but not exceptional. The banking industry has historically generated ROE in the 12 to 14% range for high-quality operators, so Westpac's 9.58% suggests either operational headwinds or margin compression. The return on assets of 0.63% is low, reflecting the thin margins inherent in banking once you account for the scale of assets. The overall profitability picture is one of adequate but uninspiring conversion. The bank is profitable, but at a declining rate relative to historical norms. On to growth. Is this business expanding, and at what rate? Westpac's revenue growth over the trailing 3 years is 3.1%, and over the past 5 years is 2.2%. This is anemic by any standard. For a major financial institution, mid-single-digit revenue growth typically reflects market maturity, saturated lending markets, regulatory constraints on lending, and intense price competition, all of which are relevant to Australian banking. Book value growth, which measures the expansion of shareholder equity capital, is 1.9% over the trailing 3 years. That is below nominal GDP growth and suggests the company is not building shareholder value through retained earnings at any meaningful pace. The dividend yield is 3.81%. Westpac pays out most of its earnings as dividends to shareholders, which is typical for a mature bank. The yield is modest but more attractive than the current risk-free rate in many developed markets. However, a dividend does not substitute for earnings growth. The growth picture is one of stagnation. Revenue is essentially flat, book value is barely expanding, and the company is in a slow-growth, mature market with limited pricing power. For an investor seeking capital appreciation, Westpac offers little beyond the dividend. The Australian banking market is mature and regulated, with limited room for organic expansion. Now let's talk smart money, what institutional capital is actually doing with this name. The data reveals a stark picture. 0 top-tier Guru holders currently own Westpac. 0. No legendary investors, no Berkshire, no mega-cap allocators, no sector specialist fund managers are taking concentrated positions in this stock. That absence is itself a signal. Insider ownership stands at 0%, meaning management team members own virtually no stock. That is a red flag. When company leadership has minimal personal capital at stake, there is no alignment of interest between management and shareholders. If executives do not believe in their own stock enough to own it, why should external investors? Insider transactions over the past 3 months show 0 buys and 0 sales. There is no activity at all. No manager is buying the stock, which might signal confidence, and no one is selling, which might indicate lockup periods or restricted shares. But the complete absence of activity, combined with 0 insider ownership, paints a picture of detachment. The smart money verdict is unambiguous. There is no smart money interest in Westpac. The stock is held primarily by index funds, Australian pension assets following benchmarks, and passive holders. There are no legendary investors fighting to own more, no insiders betting their own wealth on the future, and no evidence of accumulation by informed capital. That absence of conviction from the best-informed market participants is perhaps the most bearish signal in this entire analysis. And finally, the verdict. Let's bring it all together. On valuation, the stock is priced at fair value to slightly expensive, with an elevated PEG ratio and no margin of safety. Sentiment is bearish, and a fair value range of $27 to $29 offers minimal upside. On financial strength, the Altman Z score signals distress, the Piotroski F score is weak, and the balance sheet is leverage-heavy with tight liquidity. These are constraint signals. On profitability, the bank is converting revenue to earnings adequately at a 9.58% return on equity, but that is below historical norms and declining. Margins are healthy but not exceptional. On growth, the business is essentially flat, with 3.1% revenue growth, 1.9% book value growth, and stagnant expansion in a mature market. There is no growth thesis here. On smart money, the stock is owned by 0 top-tier investors, management owns 0%, and insider activity is 0. The absence of conviction from informed capital is stark. In our view, a fair value range for Westpac Banking Corp sits between $27 and $29, representing minimal upside of 0 to 7% from current levels, paired with significant downside risk if financial conditions weaken or regulatory capital requirements increase. The business is profitable, it pays a dividend, and it occupies a systemically important position in the Australian financial system. But it is a slow-growth, mature, highly leveraged financial institution facing structural headwinds in net interest margins, limited capital return optionality, and 0 attention from the world's best investors. The setup is not compelling in our view. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Westpac Banking Corp. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.